So now it gives me great pleasure to introduce the Managing Director of InnSight Advisory and Executive Director of Aleph Hospitality as well, to moderate this session, The Investor's Perspective. Where is investment heading? Where do investors see the opportunities moving forward? How is the asset class of hospitality and tourism viewed? Looking at the long term, and please welcome my friend Neil George. Whoop.
Good afternoon and welcome to the investment panel. We're going to spend the next 30 minutes looking at the investment climate, what's been going on, and all things to do with transactions and investments. And we thought we'd look at it from a fairly simple framework. Who is doing the investments? Are there any new types of investors coming on board? Where are these investments happening? Are there any new investment hotspots emerging? Is there a geographic skew in the transaction volumes? Why are these deals happening? What's motivating some of these deals? Is it opportunistic? Is there distress in the market? And with that, we'll cover, hopefully, the whole spectrum of the deal world. Let me introduce to you my panel, which is fabulous because it's comprised of investors from every different category. And I'll start from my extreme left. Philipp is with Mubadala. Most of you know Mubadala. It is a $145 billion sovereign wealth fund, which invests in everything from satellite communications and self-driving cars, and also a few hotels along the way. Next to Philipp is Karim. Karim lives in London, calls Dubai home, and is with Actis. Actis are a global diversified private equity firm with hotel and retail interests in emerging markets, primarily in Africa as well. And next to Karim is Fardan. Fardan is the founder and runs Embassy Capital, a multi-family asset management firm. He also runs his own family office and has investments in hotels in Europe as well as the UAE. And last but not the least, my friend Amr. Amr is a lifer with JLL. He's been with them for 14 years and has been involved in or has visibility into almost any transaction of any note in our sector. By virtue also of his spot on JLL's global hotel transaction desk. So welcome to all of our panelists. And I'll start, maybe Amr, with you to kick us off with a broad sort of overview of what you at JLL are seeing in terms of hotel transactions. Well, first of all, is there anything happening given the pandemic and everything that's been going on and travel restrictions and so on? I guess there was a kind of a full stop in 2020 and then things started to creak back to life. Tell us about it.
Sure, absolutely. Well, thank you very much for the introduction, Neil. I think, first of all, it's great to be back here. It's great to see, so many familiar faces and meet new faces as well. I think we had missed, that kind of format in 2020, even though it wasn't really that long ago, but the impact was definitely quite visible. Listen, from a transaction standpoint, at least from a hotel investment standpoint, I think the first 6 months of this year were far more active, as you can definitely expect, than 2020. So we've been tracking a lot of the M&A activity happening in our sector, and we've accounted nearly $30 billion worth of deal volume during the first 6 months of 2021. That represents approximately 40% increase to 2020 activity. As you can imagine, when let's say our industry faced a bit of a standstill in 2020, that did not stop deals or certain transactions that were carried over from 2019 to occur and to complete in 2020. So, we had to dig a little bit deeper into analyzing certain specific transactions, at least on that front. From a geographic standpoint, out of that 30 billion, look, the US really dominated the largest market share, and that is predominantly private equity capital. So, from that, there was two major acquisitions by Blackstone. One of them was the Extended Stay America portfolio, which comprised of many hotels in the select service space, as well as also with Blackstone, another group in the UK called Bourne Leisure Group. Those two deals amounted for 10 billion on their own. But moving on to a little bit more private capital, I think it's interesting to see that the appetite is there. As an asset class, look, I was expected, to see the sort of feedback and the frustration from a lot of our clients saying, you know what, JLL, thank you very much. We no longer want to invest in hotels. None of them did that globally. And, I did reach out to a lot of our international colleagues. Did anybody want to exit because they don't like the asset class? If anything, actually, investors are even more aggressive now than before. I think the dip, whether it's investment value or performance, was so deep, but also the recovery took a bit of a swift upward cycle. It kind of gives a bit of a positive stance on the longer term, on the medium and longer term from a Horizons perspective. And each continent is really different. So if I start in the US, completely different market than the rest of the world. The US has seen so much CMBS-driven defaulting, foreclosure, loans. It's not your standard relationship banking that you would get, at least in Europe, Middle East and Africa, or even in Asia. But the US also, from a vaccination standpoint, from a domestic tourism standpoint, picked up significantly, or even a lot quicker than the rest of the world. Europe is lagging behind. It's a bit of a bumpy ride, a few renewed lockdowns here and there. So that's affecting tourism visitation within the own respective market, international arrivals as well, ultimately affecting, hotel performances. But we are seeing plenty of dry powder out there waiting for the right opportunity to come. There's a significant rush towards resort properties, resort portfolios. And guess who's at the forefront of those? Once more, private equity, whether it's domestic, whether it's international. In the Middle East, it's always been and remains a development-driven market. We're not seeing enough transaction to truly conclude that we're seeing a trend. From an outbound perspective, the Middle East has always been a net exporter of capital. There hasn't been any major acquisitions. The last one I can think of significantly was the Ritz in London that we had concluded in February last year. There has been capital deployed in Africa. There has been in a few select key single assets here and there, but it's purely from a strategic standpoint. So it's not because of the market, but you will come across the investor who says, I want this property or I want that hotel. So if there is a possibility to unlock it, great. Otherwise, Middle Eastern capital just find themselves in a very competitive market.
Yeah.
Truly, we're again astonished by the amount of fundraising activity that happened in 2020. So even though there was no deals, just fundraising was just double the amount of volume of 2019 to that respect. And there is an allocation towards hotels and hospitality.
Amazing. So 40% increase year on year.
That's
this
correct.
year.
That's
That's
correct.
incredible. Who would have thought? And also to your point about resorts, I mean, ties in very well with what Sami Sawiris was saying earlier on, where he's seeing second homes being far more important, resort properties coming back online as people look to work from home, work remotely, and so on. So there's clearly some global trends here that are tying together. And I'll come back to you to talk about some emerging patterns in a bit. But with so many deals happening, let me just take 2 seconds to talk about the practicalities of getting a deal done during a pandemic and closing it. So Karim, you do deals in pretty exotic locations. How do you do that when you can't get on a plane and go there?
Yeah, well, I think it's hard, to put it plainly. I think negotiating SPAs, not being able to travel, as you said, to exotic markets, and then real estate's a business where you need to be there in person, you need to see it, feel it, hear it, touch it, and negotiating with sellers, particularly in a very sensitive environment for hotel investors and operators, it wasn't easy. I think deal timelines, we've been quite active, as I said, and we closed 2 deals within, I think, 18 months. I would have normally closed maybe in a shorter time period. But it's the typical sort of M&A ins and outs, right? It's about trust, it's about relationship building, which you don't necessarily you can't get there on Zoom when everyone's just sick of seeing a digitized version of yourself and in and out and things crawling through the background and all that stuff. So we got there in the end, and that's to say that there is still deal making to be done, but it's just expected to be a bit more complicated. And I think it's also a function of whether or not the seller was contemplating an M&A process in the first place. Both of our deals were opportunistic. They were unsolicited. And it took a lot of sort of pushing and nudging. And I think the main takeaway here is that pre-COVID, everybody was wondering where the next downturn would be, and nobody saw COVID coming, obviously. So, a lot of stock and inventory a lot of hotel stock that is, wasn't primed for sale processes to begin with. So. I always like to use the Swedish car analogy. No offense to anyone that's Swedish here. The last Saab rolled out, I think, in 2011. And you'll see where I'm going with this. In bad times, it's a consistent car. It has a lot of mileage on it, let's say. And in bad times, you value exactly that, predictability and consistency, right? And you say, okay, I'm not going to spend any money on it. Yeah, the parts are getting more expensive, maintenance is getting more expensive, but I'll just sit on it. In good times, what do? You say, well, it's a great car, it's doing well for me. It's okay, I'll spend here and there on the parts, right? But in reality, the prices keep going up, and over time that aggregates, right? And over time, the parts are becoming harder to find, the maintenance is getting more expensive. And you don't really realize that you're much better served by getting rid of that trusted sub, right? And so it goes back to this whole idea of saleability. I think when we go to investors or potential sellers and we tell them your capital is so much better off reallocated to something else when you're sitting on a suboptimal yield in relation to the risk that you're taking. Oh. And so it's about as a first principle, as a person involved in M&A, what I approach it from is, well, I'm going to put myself in the shoes of the seller and try to understand their motivations and trying to convince them that at the end of the day, that capital as an investor, as an owner, as a deployer is probably much, you're better off rotating into something that'll serve you better at the end of the day.
Yeah. So if I were to ask you lessons learned from doing deals during this period, couple of points.
Lessons learned, I think, again, like first and foremost, because, and I use the term sensitively, we're opportunistic buyers. It's really, I think, to close a deal, to be successful, you need to get yourself in the head of the seller and to get behind their motivations. I think, our deal teams collectively could have probably done more of that, and I think I'll definitely apply that going forward. The second thing is patience. I think, a lot of people here have worked in emerging markets, and things take a lot longer. So, and the third is banks, unlocking banks and lending, and in markets that are not necessarily very deep credit-wise.
Yeah, I'm hoping we'll have time to come back to that because I'd love to talk about how much there is and what there is. Let's touch a bit on the what of transactions. So Philipp, to begin with, what is the role of hospitality or hotels as an asset class in a diversified portfolio like yours, where you have everything from satellite communications to healthcare, to pretty much power plants and so on and so forth. Why hotels? Why do they belong in that portfolio?
Well, you say diversification. We are extremely diversified investment company. Mubadala, you mentioned at the outset, 240 billion under management. And hotels is, of course, a small portion of all of this. Real estate is a slightly bigger portion of it. Information, technology, life science, energy as well, historically, are huge components of Mubadala, the sovereign. And the diversification is simply crucial. We have to obviously fight for allocation internally, whether it's the hospitality platform within real estate or whether it's real estate against all the other platforms.
So how do you fight? I mean, surely you can't promise higher yields than some of the other investment opportunities.
Well, that's a challenge. That's the challenge we've been facing since COVID started, we've, as a company, Mubadala put out or increased AUM by about 12 billion since COVID started. So we've been extremely active with a strong balance sheet to invest. And that's been heavily in the North American life science or Indian IT, or also in other parts in Europe, in other real estate classes. But with high returns being driven in other platforms, the cost of capital increases, and we as hospitality and real estate, we have to move from core plus to value-added deals, or we have to take a backseat and see where when the next deal comes. We have been active in M&A in hospitality over the past 18 months, both selling and buying, and we faced exactly the same issues as Karim has. Even though it's not emerging markets, it's well-established international markets, but deals are slow. Deals take time. Just not being able to see people, it's such a simple thing, but it just kills deals.
Yeah.
And we've been working on a deal for 12 months and still going. And it's that's a challenge we have, and you compete with others in the platform.
Yeah, yeah. And Fardan, your family offices and Embassy Capital, you're invested in hotels in Europe and in the UAE, correct? And within the UAE, you're in Dubai alone?
Yes.
Which compels me to ask the question, which I think has been asked since the first hotel was ever built in Dubai, and that is, do you think there are too many hotels in Dubai?
Yes, it's a good question actually. So it's a question we usually get asked, and you can see it in a couple of different kind of ways. So if you talk about ADRs and RevPARs, there is some pressure sometimes, depending, on the events that happen. But overall, actually, having this amount of rooms gives Dubai a competitive advantage compared to neighboring cities, compared to other countries. Also, for the end user, it became a better, more friendlier market, because at some point, these rooms reach to a price point where it's not really worth that value. So I think if you look at it, there's a positive way to it. But in the negative kind of side of things, it's just a short term. It might be for short term or something, but for the long term, generally, I think it's a better thing. Then if we look at, we were just discussing with other people before I joined this panel, is that there is actually some areas where Dubai is missing, actually, in adding some rooms, which are more like the experiential kind of traveling, the rural kind of destinations. Like Al Maha Resort is a very good example.
Mm-hmm.
It's been doing very well, and I think that's also where Dubai is trying to now include more kind of products. Hatta is being one of the biggest projects, kind of tourism-wise, going forward for the next decade. I think there's going to be a focus over there. But nonetheless, again, just to recap, I think the amount of rooms are giving Dubai a competitive advantage, is becoming a friendlier place for the end user. And also some, now you see more like companies that are tour operators, having different kind of products that used to be. So I think it's honestly positive more than negative if we look at a long-term kind of investment and look at the other verticals of the economy.
Yeah.
But if you look at an asset by itself, or maybe they get an effect, it will be short-term. But then there is also asset management that should, be involved in the asset more. Try to push the asset in that kind of sense.
Yeah. So the overall maturation of Dubai as a hotel market and a spread of asset types,
Yes.
is probably what supports it. And as a family office, you're a very different category of investor to Philipp or a private equity players. How do you look at hotel deals, and what are your key criteria that are different from, everybody wants ROI and so on and so forth, but what's unique about how you look at deals?
Actually, there's nothing unique in real estate. Generally, it's a formula. So to be honest, we are commercially driven, and I'm sure everyone is commercially driven and online with that. But we do have a required rate of return that might be higher than others, and even
It would be higher, you said.
higher than
Yeah.
a sovereign wealth fund, for example.
Yeah.
But nonetheless, we do have Now we see like there's a drive to diversify even geographically, but that doesn't mean, you know, we give up commercial kind of aspects or yields or things like that. So we're not, it's not a necessary thing to do for a portfolio like a family business, and it's the most difficult capital to deploy, really. But then, nonetheless, I think we are commercially driven. When we look at deals also in Europe, we have to make sure it's commercially in line with what there is here or even better sometimes. This is why you won't see actually family money going into a trophy asset, for example. You know, they would more likely go to 4-star or 3-star plus. They will look at cities that are that you will find leases in, for example, long term. Other things is that also the cost of capital, because the required rate of return or the WACC, to bring the WACC down, going to places, let's say like Europe, for example, or the US, actually the cost of capital is much less. It's less than half of what is available here. So, you know, you take advantage of that in other kind of countries.
Sure. And Amr, are you seeing this cost of capital differentiation driving different types of deals in different parts of the world?
That's correct. So listen, we just completed a survey whereby we contacted over 1,000 of our clients, pretty much everywhere. And I think the common denominator in the results was yield expectations for hospitality was around 120 basis points higher than what it was pre-COVID. And a lot of factors can come into play. Whilst debt remains available, banks are still relatively cautious in certain acquisitions, depending on the borrower, sponsor profile, and that's in Europe and all your core markets and major gateway cities. So it's not just here. And you have inflation risks, you know, elsewhere, the other side of the continent. So to an extent, it's a fair request to get, you know, and we were surprised to see by how much private capital is positioning themselves into the debt space at the moment.
Interesting.
So, and that's becoming even more competitive for traditional lending. So you have investors who've raised funds to actually be, you know, do the loan-to-own scheme, or come in and position themselves in the capital stack in a preferred equity structure, mezz positions, mortgage participation. I mean, there are so many really out there.
And you're seeing these active in the region?
In this
or
part,
is this mostly in the US or Europe?
So we've seen appetite in the region, in this part of the world, because debt yields are extremely high. And let's face it, look, we're all friends here. And I really think in the Middle East, that's always been a challenge for international capital. Debt is extremely expensive. The way debt is structured here for commercial acquisitions, compared to anywhere in the world, is a little bit more, you know, pricier, let's say. It does not make sense that any deal you look at or any hotel owner should generate somewhere in the 7 to 8% unlevered yield just to be able to sustain and, you know, service his debt. You don't see that anywhere else in the world. So hotels are profitable, but that there's no question. But at the same time, you know, international capital is used to something different. You know, they don't pay amortization. We're still getting interest-only facility structures, you know, and term sheets. Let alone in leases to Fardan's point, we're still seeing hotels with commercial leases or operating leases trading at 3.5% in Germany and in Spain. So you kind of raise a question mark, or like, where's the impact of COVID in all of this? And I think the biggest frustration we've seen was, at least from this part of the world towards international, is where's your distress? We're not seeing distress.
Where is it, Philipp? Are you seeing any distress?
No, it's a great point Amr raises. There is no distress. If you compare post global financial crisis to today, the amount of distress that was out there, maybe there's a lag still, maybe there's still something coming. And I understand that banks, especially in the US, get a bit edgy on the real estate and don't foreclose, but put a timeline to the equity. But there is not sufficient distress for the bid-ask spread to narrow, especially not in nice prime city locations. In resorts, I think regional resorts in Europe, you see, or we see some narrowing the gap, but in prime AAA locations,
you can get the stress position, but the liquidation and the foreclosure that we used to see years ago, or at least in the past GFC, that's not there. I mean, I guess, and again, you know.
So why is that? Well, why do you? Well, let me ask Fardan.
No,
What do you
I
think?
just
Why
wanted to
is
add
there
on.
no distress?
No, I just wanted to add on to a point of Philip. Generally, we were in this year, January 2021, we were ready actually to deploy much more capital than we actually did. We were waiting for distressed assets to come to the market. We expected that at some point, they will usually, you'll see these flows coming to the market. But honestly, I think generally the lenders and the banking sector supported the landlords with all the packages that were available, and this led actually to like kind of keep the value in those assets. But generally, now we started looking, we're out of this distressed mindset, looking for like, back to normal kind of deals. Because we stayed for 1 year, actually trying to, just waiting and timing it correctly, just to, deploy correctly. But then I think we're past that. Travel is coming back slowly, and we're past the worst. So I think, honestly, now we're just looking at our deals without having a mentality of finding distressed anymore.
Yeah.
That's correct.
Amazing. I think you're seeing something very unique here. This has got to be the first investment panel where the bankers are the good guys.
They weren't the good guys, and I think they were actually quite lenient. So we have quite a significant debt practice in Europe and in the U.S., and they were able to renegotiate so much of these loan notes across key markets than much what was anticipated. I mean, look, I even encouraged some of our Middle Eastern clients here. Why don't you guys position yourself in that position too? I mean, you don't have to be on the equity front. You could be on the debt front.
Yeah.
You're still going to generate significant yield, and you don't have to be exposed to the level that some of the equity or some of the private capital can be exposed to. In the U.S., it's a bit different because CMBS, I don't know, we've tracked maybe 1,300 hotels on that list that had a foreclosure risk, and that can go from your hotel on the highway somewhere in the Midwest to your luxury property in New York. And the borrowers were always able, to an extent, to find the right partner, that can give them a bit of a lifeline. But I think what we're seeing is the impact on valuation. You will not get distressed, but you will get stressed because there's very limited offshore capital. So the crazy Asian and Middle Eastern money that used to go over a certain luxury product, that stopped. So it's now purely domestic. And who's driving domestic? It's private equity.
Yeah.
So they're saying, all right, now it's our turn. So if you're seeing private equity investing, this means, maybe we're starting to understand that or conclude that prices have bottomed out.
But Karim, private equity, did you see any cherry picking distressed deals in Africa?
Yeah, I think the story is a little bit different in Africa for a couple of fundamental reasons. I think one, banks weren't necessarily looking to play ball. There are banks that lend in the U.S. or Europe, and I think Philippe would know this much better than I would, but there are banks that are very familiar with the industry. They've been lending to hospitality assets. They understand cyclicality. That's not the case necessarily in Africa. And I think that's part and parcel of the reason distress has come into the market. Well, first in the form of stress and distress, and I think there's more to come. And the second reason is furlough schemes and government support hasn't been forthcoming. In the U.S., you saw the government becoming the consumer and lender of last resort, right? They were cutting checks. They were pumping tons and tons of money into the economy. And so there were furlough schemes in place. There was a social safety net in place that didn't necessarily play out in many markets in Africa because these governments they're simply too resource constrained. They can't meet, their budgets just can't sustain it. And then the final, aspect is there's it's a function of vaccination rates. I think I saw a statistic yesterday that a couple of the largest economies in Africa have only vaccinated 10% of their populations. I could be grossly misquoting it, but I mean, just to give you an idea of, for us, international travel into core markets is so important, and to the extent that COVID is still an issue in 12, 24, 36 months from now because, there's the God knows Zulu variant or whatever comes up in 5 months from now, it's still percolating, then it's a problem.
Yeah. So let's spend 2 minutes talking about the where. So we heard about the massive volumes in the US, some in Europe, not so much. Let's look at it regionally, in the Middle East, in Africa. Philipp, if you want to take it, where are you seeing deal flow coming from? I know you don't do most of them, but where are you seeing the flow from?
Regionally, we've been ourselves active in North Africa recently, based on historical investment though, so that's maybe not quite representative. To be honest, we have been more focused on North America. We own a hotel operator as well, with lots of hotels in the US. We've seen those hotels, resort locations, picking up massively in terms of trading performance, and that obviously spurred then the investment interest there as well. So that's where we would see more. Regionally here, we've been active on M&A side, but selling as well in GCC. Opportunistic sale was the right time. But in terms of investments locally, not all too active, I have to say.
No. But Fardan, you're focused on the UAE clearly in the region, but are you seeing activity elsewhere within the Middle East?
To be honest, we tried to look at Africa for a while, and we were interested in a couple of countries. We identified where we do want to invest. Unfortunately, Africa, to us, because whatever I was telling about the cost of funding, it's much more expensive. We found that also advice there is not really available, as other markets or data. So for us,
he's got an office in Nairobi.
Yeah, I know.
Lots of people.
Yeah. No, but I mean, generally on all of the spectrum where there is the financial due diligence, the taxation and stuff, it wasn't too clear for us initially. And, we're still actually exploring that market. But nonetheless, we are interested in Africa, especially in the North African side.
Yeah. Amr, Saudi?
Yeah.
No volume in Saudi? How is that possible?
No, listen. Look, definitely this question would not pass without saying Saudi. But Saudi is development. It's construction. And I mentioned the 30 billion. There's probably more triple of that being developed in Saudi Arabia at the moment. There's a phenomenal overhaul occurring across the entire kingdom. It's no longer just some key cities or some holy city. The revision and the tourism strategy. And look, I know there are a few sessions where this is going to be covered in more details, but it's purely development and construction. We were working on a sale of a portfolio, a rather strategic portfolio, and I think the investor appetite was also looking at it from a much more opportunistic approach. And listen, the challenge is how do you value something that doesn't produce cash flow in 2020?
But apart from the big government sponsored,
there is private capital. There is smaller.
Deal flow
there is smaller because look, private capital. Government capital will drive the smaller guys. Once you get a government-backed guarantee on a certain area with a long-term vision that this is going to revitalize the area, the infrastructure is being put in place, and the tourism, at least the main tourism attributes, are being developed, private capital will follow suit. And everybody's always looking for alternatives. But in Saudi, I think one of the key, let's say, attributes to it is that there's already product that requires renovation. There's already product that requires redevelopment.
Yeah.
So you're already starting off a very good base. Now, whether that capital or that product is available for sale or not, that's a complete separate story. In Africa, so to your point, investors are being selective. Selective on the destination, selective on the on the market. There was a phenomenal portfolio that traded earlier this year in Western Africa. We just concluded a liquidation sale in South Africa. But when you say liquidation, you start seeing the sparkles over opportunistic capital, and there is dry powder. I still stand by that comment and consistent that there is dry powder waiting for the right opportunity to come. And the basis is very slow. The basis is very low. I can take a 5-star product in London, which will cost me $1 million a key, versus Western or Southern Africa, it's going to cost me $150,000 a key. Well, the guys are like, you know what? I can take a view and afford being a little riskier, because investors have to be cautious. Also, as advisors, we cannot keep pushing and pushing and pushing. It's important to take a view, relook at things. Where do we go? And you follow a certain trend that fund managers may not have. Fund managers have dry powder, they need to deploy it.
Yeah.
Private capital is not in the same ball.
Yeah.
You know, the pace is a little bit different. So yeah, no, look, I mean, we expect more deals to happen in Africa during the second half. We have a solid pipeline at the moment, and we're confident that there's capital out there waiting at the other.
That's encouraging and quite incredible given everything that we're facing. There's so much here to unpack. Unfortunately, we have 2 minutes left, and I wanted to make sure that we give the audience a chance to ask any questions. So right here in the front.
Hi, Neil. This
Rene.
is Rene from Beaufort and President of Hama. Great panel. Cutting it short, address it to Neil, can ask the panel. Specifically, a statement that Amr made about the 30 billion of global transactions, and which boils down to, for the Middle East, pretty much 0 transactions. And this is a discussion we had this morning with Hama. It's an ongoing discussion, and there will not be a resolve to it. But the important issue that addresses everybody in this room is, why isn't there more FDI and transactions within the market, right? Specifically in the Middle East, specifically Dubai.
Well, first of all, is it the case that it's 0 transactions here?
No, I mean, look, no, that's a very aggressive statement. There are transactions happening, but to your point, yes.
To the point is that
we're not seeing a lot of FDI coming in, you know,
Paris,
buying existing
New York, Rome.
operating assets, 100%.
We're
Look,
not to
I'm with
compare
you.
those markets, we're not as mature markets, but however, the global crisis has clearly shown that we are one of the most resilient markets in the world. We're one of the
That's correct.
advanced hotel markets in the world. So this is just a global question and a continued discussion to have, and I think for all of us very pertinent in the future, why don't we have more FDI coming into our hospitality business?
So listen, in my opinion, the answer to that question is threefold. And I'm going to wear the hat of an institutional
You have
buyer.
like 7 seconds.
Looking into Dubai for the first time. One, cost of debt, very expensive debt compared to the rest of the world, and you need to drive a far higher yield for a currency that's pegged to the dollar compared to anywhere else in the world. One. Two, opacity and transaction data. Today, it's so difficult to get information on price per key and transaction comparables, even if they do happen, because you have a lot more direct approach.
Amr, I'm gonna have to cut you off there. I'm sorry, I don't also think we have time for any further questions, do we, Jonathan? No, we don't. We have to get off the stage.
1 minute,
So
Jonathan.
please join me in thanking our panel,
Blame it.
Philipp, Karim, Fardan, and Amr. Thank
you.
you.